So Alan, please.
Thank you very much, Paul, and thanks to the other panelists for some provocative presentations. I'm going to take things on a little bit of a different tack and try to expand and maybe zoom out a little bit in three ways to think about not just policy actions, but policy regimes moving forward, which economists distinguish between, to think about domestic versus global tensions in international macroeconomics and finance, and also to broaden the time frame and also look back at economic history, which is already emerging as, I think, an important theme in this conference and for INET. So I think we know where we are and why we're here. We're in the worst global financial crisis and recession since the 1930s. It may even be the largest macroeconomic and financial shock we've ever seen. It's just that we have slightly more benign policy responses this time around to try to contain the downside. But still, in all economies, certainly the developed economies, we're mired in quite a deep slump with high levels of unemployment, large output gaps, things that were unimaginable a few years ago when people were bandying about terms like great moderation. Right? And the main culprit, I think, is clear enough. Financial crises are very painful. And here's some evidence from some recent research I've been doing. Financial crises resulting from widespread malinvestment, often in real estate bubbles, with over-leverage, are a common feature of economic history. And they damage household and financial sector balance sheets, and that's been the case this time with a great deal of contamination there. And those balance sheets need to be repaired and delevered, and that takes time and is painful, as Richard spelled out in his presentation. And this slide shows some of the macroeconomic responses to recessions, crisis recessions and global crisis recessions over history for both the pre-war and post-war recessions. Things are slightly more benign after the Great Recession. Policymakers do react, especially monetary policymakers react. So in chart 1, you can see that we don't have the Fisherian debt deflation of the pre-war years anymore. But we do have much more painful responses in terms of more contractions in credit and equally painful real economic effects in terms of economic slowdowns. And I think there's a simple reason for that, which I'll come to in a moment. Now, not all the news is bad, right? Because in emerging markets, oddly enough, the damage has been much more limited, right? They suffered some contagion. Everybody thought they're high beta, right? But although they slowed down for a short time, they were affected by the global trade crisis quite severely. They've rapidly rebounded. So we've got this two-track recovery going on. And the emerging markets have remarkably so far escaped without any currency, financial, or default crises of their own. And I think it's fair to say if anybody had predicted that 5 years ago, that after a global financial crisis like this, the emerging economies would emerge like this, people would have thought you were bonkers, right? So I think the scale of this crisis and also this two-track recovery tells us something about what was going on beforehand and about some of the failures in economic policy making and the kind of complacency that had built up. But what were the failures, right? And for the sake of simplicity, maybe I'm going to put two things in stark opposition, but they're themes that have already bubbled up in the conference. I think you can narrow it down to two things. There's a lot of debate on blaming global imbalances. I'll call that the external problem. And also a lot of debate over what I'll call the internal problem, domestic finance. So if you think about what is the focus of energy, say, of the G20, the IMF, if you think of those kinds of debates, should we have a 4% current account cap or all of these indicators, that's very much people spending a lot of their energy on global imbalances. Whereas if you think about the work of the financial regulators, be it the BIS, the Basel Committee, national regulators like Adair Turner, who's going to speak to us later today, they're focused on the first problem, the internal problem of regulating domestic finance. Right? And this risks oversimplification, but I think that's useful, and I've only got 15 minutes, so I might as well make it as simple as possible, and then we can provoke some debate afterwards about the relative balance of these two problems. So my approach and my point is that we should look through the economic fallout and what's just happened, but also look back really in the only laboratory that we've got, which is the historical laboratory, and try to say something useful about trying to, if you like, sift out these competing explanations of where the problems arose, right? So a historical approach, I don't need to persuade you. I mean, many people have said kind things about economic history, and of course economic history is emerging into the forefront of debates. Ken Rogoff spoke about it yesterday, and Carmen Reinhart's here, and their book is a superb example of how I think it can inform us as we debate policies going forward. But there are obvious pitfalls, right? So, I mean, the trite thing is just to say we can learn from history, right? And this is if you like, Tocqueville's point, right? When the past no longer illuminates the future, the spirit walks in darkness. So as long as we just paid attention, you know, maybe we'd be all right, right? But there's also a pitfall with using economic history, any kind of history, to try and understand the present and shape policies going forward. And that is, I would say, the Taylor view. And this is A.J.P. Taylor, who can't claim to be a relation, merely a namesake. And he said he was what I often think is a dangerous thing for a statesman to be, a student of history. And like most of those who study history, he learned from the mistakes of the past how to make new ones. Right? And I worry that these two perspectives may apply to the two big problems that I'd outlined on the previous slide. I think we're getting a lot of true illumination from economic history on the financial instability problem, and the problem particularly of credit booms and leverage and the problems that they can cause in terms of raising the risk of crises. But I'll argue, just to be provocative, that when it comes to global imbalances, we may be drawing the wrong lessons from history, in particular from recent history, a kind of false illumination that we're getting from looking underneath a misplaced lamppost. Right? So on the first point, financial regulation, I think history can teach us a great deal. There are strong empirical regularities in the history of developed countries, and not just emerging markets, showing that credit booms have a tendency to end in crisis. And sure enough, this time has not been different. Right? And I think history speaks very clearly to that question. On the second point, the global imbalances, many say they're in some ways responsible for the crisis, and if we don't do something about them, they might cause more problems in the future. But I worry that there are two problems with that view. First, as a diagnosis of what has just been happening, and not just in the recent past, but over the long sweep of history, I don't think that's entirely correct. And there's been something very special about recent history that I'll come to in a moment. And secondly, as a roadmap for the future, all this talk of global imbalances may be a very poor guide, given the changes that are unfolding, I think, quite rapidly. So let me try and flesh out each of these two arguments in a little more detail before I conclude. The first question I want to consider is whether credit booms might be causally responsible for financial crises. And that's been studied by many scholars, by Carmen on my right with Graciela Kaminski, by the team at the BIS, Claudio Borio and Bill White, for example. And the results of that research agenda, you know, they've been mixed. Many other people have gotten involved. But I think one of the things that comes out most strongly as a useful indicator of problems ahead is credit booms and credit expansion. Right? And so the BIS warnings in the mid-2000s concerning a risk of a financial crisis in the advanced economies now look very prescient. Right? And in my own recent research with Moritz Skulerik, I've sought to expand and in some ways narrow that research, focusing only on the developed economies so that we can't be criticized of people saying, well, you know, a lot of this sample is just emerging market countries and they're different, and they're not so different, it turns out. So let's sweep them out of the empirical analysis, but let's expand the data set back to the late 19th century. And then we can look at a very large and statistically useful sample of developed countries, and we find the same thing is true. Right? So the data requirements for that study were quite severe. We had to go back and reconstruct the credit histories of about 14 developed countries. But I thought it was a useful exercise. That's going to be useful data for many questions going forward. Then we could take that data and marry it with well-known economic time series, macroeconomic time series, and data sets on the history of crises that have been produced by Bordeaux and Eichengreen and by Ken and Carmen. So just to remind you, here are the Reinhart-Rogoff data series for high-income economies, the frequency of crises, middle and low-income economies, frequency of crises. And apart from this peculiar oasis of calm from the World War II up until the 1970s, we can see that there is a long history of recurrent crises in both groups of economies. Right? The period from the 40s to the 70s is interesting. It's the Bretton Woods period, but it's also a period of extreme financial repression. Right? We have things like Glass-Steagall in this country and similar regulations in other countries. So in terms of saying, you know, course correlations, is there any identification there? There really isn't, because you've got two things going on. Bretton Woods put on capital controls and shut down global imbalances, and domestic regulation, you know, really put the lid on finance, right? You can appreciate that a little bit more if you look at the long-run data on leverage. And this is the original data from my study with Moritz Schulerich. And what we really came to the conclusion here as we looked at this, the first time we produced this chart, we couldn't believe it. What it's sort of saying is if you look at bank lending, the blue line relative to GDP, or bank assets, which includes interbank lending, the bank loans series is just loans to the non-financial sector, that's really exploded, right? So if you go back to 1870 up to the Great Depression, it kind of rises a little bit and then levels off. And also the credit series are also tracking more or less what the money series are telling you. Right, so in a sense, the Friedman-Schwartz money view is quite a good proxy for also what's going on in the credit system. Since World War II, this hasn't been the case. Money and credit have delinked. We had a recovery in these series up to the 1970s, but then things just went through the roof on the credit side because banks took on more leverage, and also then they went to wholesale sources of funding. So there were ways to just generate credit out of thin air, completely disconnected from money. I think that sort of explains how we got to where we are today. We're skating on thinner and thinner ice, generating more and more credit on more and more leverage, and that's a well-known story. But if credit booms are the problem, what can we do about them going forward? Well, I think obviously I think this is the important problem of the two problems, and it's being addressed through regulatory initiatives at the international level, like Basel III. And also at the national level by the choices that individual regulators are taking, things like Dodd-Frank and choices that are going to be made by the Bank of England, the Federal Reserve, and so forth. And some of those national regulators may go further than the Basel recommendations. Capital ratios are going to have to rise. They may have to be pro-cyclical. We might try to be there for moderating the booms before the busts. Regulators are going to demand to be more intrusive. They're going to want more powers, more information, from those they regulate. Stress testing will become a regular art, if not a science. And central banks and other regulators are going to worry more and more about macro systemic risk and not the micro risk of the individual entities they look at. So I think that all of that is welcome. There are some caveats and some problems with that, which we'll leave for the discussion section, if you like. But I think that is entirely a right focus for what we're doing going forwards. So in the time remaining, let me turn to problem number 2, global imbalances. I really don't think that is such a major problem, and I think partly we need to understand that the last 15 years have been special. Right, so what's been going on? We've had the great reserve accumulation, but it's possible that this is a unique phase in history. It has some similarities to what emerging nations got up to under the gold standard, when they operated on much higher gold backing ratios than the core economies. There is some historical backdrop there. And it generated this perversity, that there was a net flow of capital into the rich countries from the poor countries, the so-called Lucas paradox, right? But if you dig deeper, dig behind that, you find that, in fact, private capital was flowing downhill properly from rich to poor countries, as you would expect. It was just being offset by even larger official outflows going in the opposite direction. So it's not enough to just look at the net numbers. There's an important story about gross flows underneath, right? Now, one thing we did in the study with Moritz, with a co-author, Oscar Jorda from UC Davis, we actually ran a horse race where we put global imbalances alongside credit as basically a tool for predicting crises. And we found that credit won out enormously. It was highly statistically significant. And current accounts didn't have much explanatory power. And I can go into some more details of that in the discussion section. But I think the empirical evidence from history here is also that the domestic conditions matter more than the external conditions. My other concern going forward, I guess, is that we're going to be entering a different world. I mean, I subscribe to the view that Skidelsky mentioned in the last session, others have said, that this was a self-insurance situation, right? The emerging markets came out of the 1990s very scared and realizing that if they had to rely on the IMF for emergency financing, it could be slow, it could be very limited, it could come with onerous conditions, and it could be quite politically damaging for them. So this is the picture of the 1990s. Where was this? Indonesia, right? And this is Kamdesu overlooking Suharto. And nobody wants to have their picture on the front page like this ever again. right? And so in response to these events and the economic and political damage that they caused, emerging markets said we're going to engage in massive reserve accumulation, right? And their reserves have gone from about 200 billion around 1990 to 4 trillion today, or from 4% of their GDP to 27%, right? And here's another picture. Sometimes a picture is worth 1,000 words. And here's one of our heroes. That's Michel Bachelet, and on the left is Andres Velasco, who is here, who's not just a great economist, he's also a great policymaker who puts into practice principles like, we'll spend what's permanent and we'll save what's transitory, right? So in Chile, the remarkable fact was that going into the crisis, they had saved and saved and saved, and that wasn't always popular. And Andres was telling me over dinner last night his popularity rating was about 30%, and there was quite a lot of pushback in government, on the streets. And then the crisis hit, and Andres got out the checkbook, right? And his popularity rating shot up to 70 or 80%. And I know a bit about Latin American economic history. That's one of my other little fields I dabble in. And the idea of a Latin American finance minister with counter-cyclical approval ratings struck me as, unique and maybe a first in history. So that was, that's the backdrop to what's been going on, I think, in the last 15 years. But I think that's about to change. I think one can argue that these reserves are now enough on some level. How can you say that? Well, the emerging countries have just navigated the worst financial shock in 80 years, or maybe in history. And they haven't had any crises of their own. So there's a stock versus a flow effect here. They've been building up. There was a step change where they had to go from very low reserves, inadequate reserves, to a very high level. But that was the story of the last 15 years. Going forwards, things could be very different. And I want to talk about three, in the minus 1 minute I have left, I want to talk about three things that are changing very rapidly, both cyclically and in terms of cyclically and trend-wise. The first is, well, we know there's a two-track recovery going on, but I think many people think, possibly for the reasons that Richard Koo mentioned, that the developed world could be in a very slow grind for a decade or so. The emerging world is just powering ahead. There's also the cyclical rebound that we had incredible capex postponement during the crisis. Investments just fell. In the US, the bottom chart, gross investment went down and virtually hit depreciation. There was no net investment for a year in the United States. So all of these countries are going to be ramping up to recover from that capex postponement, but I think that's going to be stronger in the emerging markets. There's going to be stronger investment demand. The other non-news, really, is that there's going to be probably lower savings globally, partly for the demographic burden that we all know about, but that the favorable demographics in the emerging market countries are about to come to an end and reverse. And so the sort of savings glut, investment drought dynamic we've had for the last 15 years could reverse quite abruptly, and that decline in real yields may be coming to an end. And I think that's a theme we've heard a lot recently, for example, in the report by Michael Spence for McKinsey. And the last thing to say is signs of rebalancing are also showing up in real exchange rates. Right? This shows the emerging markets' real and nominal exchange rates since 2001. And if you look at real, there actually has been quite a move towards appreciation in emerging market economies. In terms of nominal, not so much. But I think that's about to change as well, partly because emerging markets have moved away a little bit from their fear of floating problems, and the reserve accumulation helps them with that. It's gotten rid of the currency mismatch. But also, they're now just having to face up to other challenges, right? The productivity difference is going to mean more inflation a la Balassa-Samuelson. They're also on a cyclical rebound, which is always inflationary, and we're getting all of these idiosyncratic commodity price shocks. So to listen to the CEO of Walmart last week saying, the China price is going up, and the reason for that is both domestic inflation in China and the renminbi is appreciating. So my bottom line, to summarize, I think focusing on global imbalances versus domestic financial regulation, I would put more weight on financial regulation. Even if the global imbalances start to fade away, as I've argued that they will, it's still possible to have financial crises, even in economies that are reasonably close to balance, because you still have a financial sector that can lever up, and you may want to focus more of your attention on that going forward. So it's the size of saving flows, not whether they're domestic or foreign, that matters. And that's not just the lesson of 2008. I think it's the lesson of economic history.
Okay, thank you very much, Alan.